Most investors think markets fear bad news. They don't. Markets fear the moment when the price on your screen stops behaving like a reliable bridge to the real world. And almost nobody notices it until after the damage is done. Because the biggest breaks rarely arrive with sirens. They arrive as small distortions, a widening gap between related prices, liquidity that looks fine until it suddenly isn't, or a system that still functions, but with less trust inside it. This is why professional risk teams don't start with headlines. They start with plumbing, the quiet infrastructure that keeps trades clearing, keeps settlement predictable, and keeps arbitrage honest. When that plumbing is healthy, price differences don't last. Capital flows, spreads compress, and the system self-corrects. But when the plumbing is under stress, whether from volatility, operational constraints, or cyber risk controls, the same market can look normal to most people while behaving very differently underneath. So the real question isn't, what scary story is going viral today? It's, what has quietly changed in how the market functions, and what risks appear when function changes before price fully adjusts. Over the past several trading sessions, precious metals markets experienced unusually large price movements and structural stress, particularly in gold and silver futures and related physical markets. First, price behavior changed noticeably. Gold and silver prices showed sharp, rapid moves within a short time frame, with volatility exceeding what had been observed in the prior weeks. Compared with the previous month, intraday ranges widened, and price adjustments occurred faster than normal during periods of thinner liquidity. Second, market data publication experienced delays and inconsistencies. During a period when markets were closed or operating in limited electronic sessions, some routinely published exchange reports were not updated on their usual schedule. The exchange operator publicly attributed this to technical or reporting issues. No statement confirmed insolvency, delivery failure, or loss of assets. The issue described was operational in nature. Third, physical versus paper pricing diverged more than usual in certain regions. Premiums for immediate physical delivery in parts of Asia increased relative to futures-linked reference prices. Such divergences are not unprecedented, but the speed and size of the change stood out compared with recent norms. Fourth, liquidity conditions shifted. Market participants reported reduced willingness among some dealers and liquidity providers to intermediate risk aggressively during this window. This was reflected in wider bid-ask spreads, lower display depth, and slower price convergence between related contracts and venues. Fifth, positioning and exposure sensitivity increased. Elevated open interest combined with higher volatility meant that relatively small price moves had larger effects on margin requirements and risk limits. As a result, some participants reduced exposure or paused activity temporarily, further thinning liquidity. Compared with last week, the key change was not simply price direction, but market behavior. Spreads widened rather than narrowed. Liquidity appeared episodic rather than continuous. Operational reliability, even if only temporarily affected, became a focal point for risk assessment. Compared with last month, the difference was the concentration of multiple stresses at once: volatility, reporting delays, physical premiums, and cautious liquidity provision occurring simultaneously. These facts establish the environment in which the market is now operating, one characterized by heightened sensitivity to operational reliability, delivery certainty, and liquidity conditions, without any confirmed declaration of default, force majeure, or systemic failure. What matters most in this situation is not the headline price move, but the chain reaction that can follow when market structure comes under stress. In a normally functioning market, price differences between related instruments or locations are temporary. Arbitrage activity, buying where prices are lower and selling where they are higher, acts as a stabilizing force. This process depends on three conditions: reliable settlement, predictable delivery terms, and sufficient liquidity. When all three are present, spreads narrow quickly and confidence remains intact. When one of those conditions weakens, the effects are not immediate crashes, but behavioral shifts. The first order effect is risk reassessment. Dealers, banks, and proprietary trading firms continuously evaluate not just price risk, but operational and settlement risk. If confidence in reporting timeliness or delivery certainty declines, even temporarily, participants widen spreads, reduce position sizes, or step back entirely. This does not require a confirmed failure, only uncertainty. The second-order effect is liquidity feedback. As some participants reduce activity, the remaining liquidity becomes thinner and more fragmented. Thinner liquidity amplifies price moves, which in turn increases volatility metrics. Higher volatility triggers stricter internal risk limits and margin requirements, reinforcing the pullback. This loop can occur without any single actor intending to destabilize the market. The third-order effect is price signal distortion. When liquidity thins and arbitrage slows, prices become less effective at transmitting information. A futures price may still trade, but it reflects fewer participants and more constrained risk appetite. Meanwhile, physical premiums can rise as buyers place greater value on immediacy and certainty of delivery. This does not mean one price is real and another is fake, but it does mean they are responding to different constraints. Who is impacted first? Short-term traders and leveraged participants are affected earliest because margin sensitivity increases when volatility rises and liquidity falls. Market makers and dealers are next, as balance sheet usage becomes more expensive and less predictable. End users and long-term investors feel the impact later, through higher transaction costs, wider spreads, and delayed execution rather than immediate losses. Beyond metals, the broader implication is about confidence in market plumbing. Modern financial systems rely on trust that clearing, settlement, and reporting will function even during stress. When that trust is questioned, even briefly, participants adapt defensively. Defensive behavior, taken collectively, can reshape market dynamics far more than any single news item. This is why episodes like this matter beyond today's price. They test whether the market can continue to self-correct under strain, or whether additional safeguards, interventions, or rule adjustments become necessary to restore confidence. Understanding this cause and effect chain helps separate structural risk from emotional reaction and keeps attention focused on function, not fear. Periods when market structure becomes the focus are not new. While the current situation has unique features, there are historical parallels that help place it in perspective, without assuming identical outcomes. One relevant comparison is 2008, during the global financial crisis. In the months leading up to major failures, markets did not initially react to headlines. Instead, stress appeared in funding markets, settlement confidence, and counterparty behavior. Before prices collapsed, liquidity quietly retreated and interbank spreads widened. The lesson from that period is that function often deteriorates before price fully reflects risk. However, the scale of leverage and interconnected credit exposure in 2008 was far greater than what is currently evident in commodity markets. Another reference point is 2020. During the early stages of the pandemic, precious metals markets experienced sharp dislocations between futures prices and physical premiums. Logistics constraints, refinery shutdowns, and transportation bottlenecks temporarily impaired arbitrage. Importantly, this episode showed that price divergence can occur without insolvency, and that markets can normalize once operational constraints are resolved. What differs today is the emphasis on cyber resilience and operational continuity, rather than physical supply chain disruptions. A third example is 2022, when the London Metal Exchange suspended nickel trading. Prior to the suspension, extreme price moves were driven not by physical shortages alone, but by position concentration, margin dynamics, and liquidity withdrawal. The key takeaway was that exchanges will intervene to preserve systemic stability, even at the cost of short-term price discovery. This precedent matters because it shows that rule-based intervention is part of modern market risk management. What makes the current environment different is the convergence of structural concerns. Elevated geopolitical risk affecting operational assumptions, increased focus on cybersecurity across financial infrastructure, higher sensitivity to liquidity due to tighter financial conditions globally. At the same time, important differences remain. There is no confirmed default, no declared force majeure, and no verified loss of assets. Core clearing systems continue to operate, and markets remain open. History used properly does not predict outcomes. It filters emotion. It reminds us that stress episodes can escalate or dissipate, depending on how quickly confidence in market function is restored. The purpose of looking back is not to forecast a collapse, but to recognize familiar warning signs while staying grounded in what is actually confirmed. At moments like this, professional analysis avoids certainty and focuses instead on conditional outcomes. Markets rarely move in straight lines, and structural stress can resolve in more than one way. The goal is not to predict a single future, but to map plausible paths and understand what would cause the market to move from one scenario to another. Below are three scenarios framed in probabilistic terms. Bull case, structural stress resolves, confidence rebuilds. If operational reporting normalizes, liquidity providers return, and delivery mechanisms continue to function without interruption, then the recent dislocations would likely be remembered as a short-lived stress event rather than a regime shift. In this scenario, physical premiums gradually compress as logistics and settlement confidence improve. Arbitrage activity resumes, narrowing regional and instrument-based spreads. Volatility declines, allowing leveraged participants to re-enter in a more controlled manner. This outcome does not require exceptional demand growth, only the restoration of predictability. Historically, when exchanges clearly communicate and operational issues are resolved quickly, markets tend to stabilize even after sharp moves. Under this case, prices may remain elevated compared with last month, but without runaway dynamics. Base case, partial stabilization, higher structural risk premium. The most likely outcome based on prior market episodes is a middle path. If operational issues are resolved but participants remain cautious, then markets may function normally but with a higher embedded risk premium. Liquidity would return unevenly, and some arbitrage channels would remain less active than before. In this scenario, spreads narrow but do not fully return to recent historical averages. Volatility remains higher than normal, especially during off-peak trading hours. Physical premiums stay elevated, reflecting preference for immediacy and certainty rather than fear of outright shortage. This environment favors disciplined positioning and penalizes excessive leverage. Prices respond more to positioning and liquidity changes than to headline news. From a structural perspective, the market adapts rather than breaks. Bear case, escalation of structural constraints. The downside scenario is not defined by price weakness alone, but by further erosion of market function. If reporting delays persist, delivery confidence weakens, or additional constraints are introduced, whether regulatory, operational, or liquidity related, then defensive behavior could intensify. Under this scenario, liquidity providers continue to reduce exposure. Volatility increases as fewer participants are willing to warehouse risk. Exchanges or clearing bodies may implement protective measures such as trading limits or rule adjustments to preserve stability. Importantly, this scenario does not assume malicious intent or system collapse. It reflects how markets behave when uncertainty remains unresolved for too long. In such conditions, price moves can become abrupt, not because of new information, but because fewer participants are willing to stand in the middle. Why scenario thinking matters. Scenario analysis shifts focus from emotional reaction to risk preparation. It acknowledges that markets can absorb stress, but also that recovery depends on restoring confidence in function, not just in price. By framing outcomes conditionally, investors and risk managers avoid binary thinking. They remain flexible, adjust exposure as evidence evolves, and recognize that the most dangerous moment is not when volatility is high, but when assumptions go unexamined. In periods of structural stress, the most important signals are rarely the loudest ones. Rather than focusing on viral narratives or single price prints, I monitor a small set of indicators that consistently reveal whether market function is stabilizing or deteriorating. First, the US dollar index, DXY. A strengthening dollar typically tightens global liquidity, increasing stress on leveraged positions and funding-dependent trades. If recent market strains are easing, the dollar should stabilize or soften. Persistent dollar strength, by contrast, would suggest that financial conditions remain restrictive, increasing the likelihood of continued volatility. Second, Treasury yields and the yield curve. Sharp moves in short-term yields often reflect stress in funding markets. I pay particular attention to whether yields rise due to inflation expectations or due to liquidity premiums. The latter tends to coincide with reduced risk appetite across asset classes, including commodities. Third, inflation data, especially CPI and PCE, not for the headline number alone, but for the direction of surprises. If inflation prints consistently above expectations, real rates may remain elevated, influencing capital allocation decisions and opportunity costs for holding non-yielding assets. Fourth, volume and liquidity metrics in futures markets. Sustained recovery in trading volume, combined with narrower bid-ask spreads, would indicate returning confidence among market makers. Conversely, declining volume during price moves would suggest that fewer participants are willing to engage, increasing fragility. Fifth, open interest and positioning. Changes in open interest help distinguish between short covering, new long positioning, and liquidation. Rising prices with falling open interest often indicate stress-driven repositioning rather than fresh conviction. Finally, physical market premiums and delivery times. Premiums provide real-time insight into how participants value immediacy and certainty. Stabilizing premiums and normal delivery timelines would signal that logistical and settlement concerns are easing. Taken together, these indicators form a process, not a prediction. Each one answers a narrow question, but collectively they reveal whether the market is healing or remaining vulnerable. This disciplined approach helps separate structural signals from noise and keeps decisions grounded in evidence rather than emotion. Markets go through periods when price moves faster than understanding. When that happens, the instinct is often to search for dramatic explanations or decisive turning points. Experience suggests a different approach is more useful. What matters most in moments like this is discipline. Discipline in separating confirmed information from speculation, discipline in managing risk before seeking returns, and discipline in allowing time for structure to normalize. Nothing observed so far requires assuming systemic failure. At the same time, it would be careless to ignore signs of temporary stress in liquidity, settlement confidence, and participant behavior. Both extremes, panic and complacency, tend to be costly. For investors, this is a reminder that markets are not just prices on a screen. They are systems, and systems occasionally need time to adjust under strain. This isn't investment advice. It's simply how I'm reading the market right now, patiently, conditionally, and with respect for uncertainty. Risk management, not prediction, remains the most reliable edge over the long term.